Before we begin, please be aware that the content in this presentation is for informational and educational purposes only. It is not intended to be a substitute for professional financial advice. All forms of trading carry a high level of risk, and you should not risk more than you can afford to lose. The information provided here is not an endorsement of any particular strategy, and past performance is not indicative of future results. Please consult with a licensed financial advisor before making any investment decisions. Over $6.5 trillion. That's not for a year or a month. That's the amount of money that changes hands every single day in the global foreign exchange market. To put that in perspective, it's more than the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange combined. It is the largest, most liquid financial market on the entire planet. And the entire story of that massive daily flow of capital is told right here on a chart. But for 99% of people who look at one of these for the first time, it might as well be an alien language. It's a chaotic mess of red and green bars, jagged lines, and blinking numbers that seem to have no rhyme or reason. Feels overwhelming, intimidating. You see it and think, this is for Wall Street quants with PhDs in mathematics, not for me. And you click away. If that sounds familiar, I want you to know one thing: that feeling is completely normal. But the reason it feels so complex isn't because you're not smart enough. It's because no one has ever handed you the dictionary. No one has ever taught you the alphabet of this visual language. That is exactly what we are going to change right now. This series is designed for one person, the absolute beginner in the United States who wants to finally understand what these charts are saying. We're not going to talk about get-rich-quick fantasies. We're not going to overwhelm you with 50 different complex indicators. We are going to do one thing and do it incredibly well. We are going to teach you how to read a Forex chart from the ground up with clarity and confidence. We're going to cut through the noise. We will demystify the jargon that scares so many people away. By the end of this series, you won't just see lines on a screen anymore. You will see stories. You'll see the push and pull of global economies, the sentiment of millions of traders, and the potential patterns that emerge from this collective behavior. You'll learn the language of the market. And it all starts with a single simple shape, the candlestick. Forget everything else you think you know. Forget the complicated trend lines, the squiggly indicators, all of it. For now, we are focusing on the atom, the fundamental building block of every single price chart you will ever see. The candlestick. So what is it? It looks like a simple rectangle with a line coming out of the top and bottom. But that simple shape is packed with an incredible amount of information. Each candlestick tells you the complete story of the battle between buyers and sellers over a specific period of time. Whether you're looking at a 1-minute chart or a 1-day chart, each candle tells you 4 crucial things: the opening price, the closing price, the highest price, and the lowest price within that time frame. Let's break it down. Think of it like a short story. The main, thick part of the candlestick is called the body. This tells you where the price started and where it ended. If the candle is green, it typically means the price closed higher than it opened. Buyers were in control. They won the battle for that session. The bottom of the green body is the opening price, and the top of the body is the closing price. It's a story of upward momentum. Now, if the candle is red, it means the price closed lower than it opened. Sellers were in control. They pushed the price down. In this case, the top of the red body is the opening price, and the bottom of the body is the closing price. It's a story of downward pressure. Simple, right? Green means buyers won, red means sellers won. But what about those thin lines sticking out of the top and bottom? Those are called the wicks or shadows. And they tell the rest of the story. The very top of the upper wick shows you the absolute highest point the price reached during that period, even if it was only for a second. And the very bottom of the lower wick shows you the absolute lowest point the price hit. Think of it like a tug of war. The body shows you who ultimately won the war. The wicks show you the skirmishes that happened along the way. A long upper wick on a red candle, for example, tells a fascinating story. It says that at some point buyers made a huge push and drove the price way up. But then, sellers came in with overwhelming force, slammed the price all the way back down, and even managed to close below where it started. It's a story of a failed rally, a powerful rejection of higher prices. Conversely, a long lower wick on a green candle tells you that sellers tried to drag the price down, but buyers stormed back, rejected those lower prices, and pushed the price all the way up to close on a high note. It's a story of resilience. Once you understand this simple concept, the open, high, low, and close, you've unlocked the fundamental code. You are no longer just seeing red and green bars. You are reading miniature stories of conflict, momentum, and indecision. And when you start stringing these stories together, one candle after another, a larger narrative begins to form. That narrative is the trend. That is how you begin to read the market. Now, why is this especially relevant for us here in the US? Because the United States dollar is the king. It's the world's primary reserve currency. That means the vast majority of that $6.5 trillion traded every day involves the US dollar on one side of the transaction. Pairs like the euro versus the US dollar, or the US dollar versus the Japanese yen, are the most heavily traded pairs in the world. The story these charts tell is directly linked to the health of the US economy, the decisions of the Federal Reserve, and the flow of capital in and out of American markets. Furthermore, the world of Forex operates 24 hours a day, 5 days a week, across different major financial centers: Sydney, Tokyo, London, and finally New York. When the New York session opens at 8 a.m. Eastern Time, it overlaps with the London session, creating the period of highest trading volume and volatility. Understanding how to read the candles during this specific US-centric window is a critical skill. The story the market tells when Wall Street wakes up is often the most important chapter of the day. So our goal is simple. We're starting with the alphabet, the individual letters, which are the candlesticks. We're learning what a green candle means versus a red one. We're understanding the story told by the body and the wicks. This is the foundation upon which everything else is built. You cannot read a book without knowing the alphabet, and you cannot read a chart without fluently understanding the story of each individual candle. In the parts to come, we'll start forming words and sentences. We'll look at how specific combinations of these candlestick letters create powerful patterns. We'll learn how to identify the market's grammar by drawing simple lines of support and resistance. And we'll learn how to read the overall plot of the story by identifying major trends. But for now, your only mission is to absorb this one core idea. A candlestick is not just a shape. It is a story of a battle between buyers and sellers, told in the simple language of open, high, low, and close. Master this, and you've already taken the single most important step from being an intimidated observer to becoming an informed analyst. You've found the dictionary to that alien language. So now that you have the dictionary, let's learn the grammar. A single candle tells you the story of a specific moment, but the real narrative, the epic saga of the market, is written when you string these candles together, one after another across time. And that brings us to one of the most crucial concepts you'll ever learn: time frames. Think of a chart like a digital map of a country. If you zoom all the way out, you see the major interstate highways, the massive mountain ranges, and the coastlines. This is your daily or weekly chart. Each candle represents an entire day or an entire week of trading. It gives you the big picture, strategic view. You see the massive, long-term direction of the currency pair. Is the economy generally strengthening or weakening over months, or even years? This is where long-term investors and position traders often spend their time, looking at the grand tides of the market. Now zoom in on that map. You start to see states, then cities, then major avenues and boulevards. This is your 4-hour or 1-hour chart. Each candle now represents a smaller chunk of time. You're no longer looking at the coastline. You're looking at the flow of traffic through a major city during rush hour. You can see the medium-term trends, the swings that happen over the course of a few days or a week. This is a popular perspective for what are known as swing traders, who aim to capture one of these significant moves before the trend changes again. Zoom in even further. Now you see the individual city streets, the traffic lights, the stop signs. This is your 15-minute or 5-minute chart. You're seeing the tactical, moment-to-moment action. Every candle is a tiny snapshot. This is the domain of the day trader, someone who is looking to analyze the market's behavior within a single trading session. And if you zoom into the absolute maximum, the 1-minute chart, you're looking at every single turn, every pedestrian crossing the street. This high-frequency view is often used by scalpers, who are analyzing the smallest fluctuations in price. There is no best time frame. The question isn't which one is right. The question is, what story are you trying to read? The highways and the city streets are telling different parts of the same story. A traffic jam on a local street doesn't mean the entire interstate system is shut down. Similarly, a small dip on the 5-minute chart doesn't necessarily mean the powerful uptrend on the daily chart is over. Understanding how to look at multiple timeframes gives you context, the single most powerful tool for a chart analyst. It's the difference between seeing one tree and seeing the entire forest. Now, regardless of which time frame you're looking at, every single chart is driven by one thing: a battle. An eternal, relentless tug-of-war between two opposing forces, the bulls and the bears. You've heard these terms, but let's make them real. The bulls are the buyers. They believe the price is going to go up. They are optimistic. They charge forward, horns up, trying to push the price higher and higher. When you see a green candle or sometimes a white one, that's a bull victory for that period. The buyers were in control. They managed to close the price higher than where it opened. The longer the body of that green candle, the more decisive their victory was in that round. The bears are the sellers. They believe the price is going to go down. They are pessimistic. They swipe down with their claws, trying to drag the price lower. When you see a red candle or sometimes a black one, that's a bear victory. The sellers overwhelmed the buyers, and the price closed lower than where it opened. And just like with the bulls, a long red body signifies a powerful, dominant push by the bears. Every single candle on your chart, from the 1 minute to the weekly, is just a snapshot of a single round in this epic fight. The wicks, those thin lines, show you the frantic struggle at the extremes. A long upper wick on a red candle tells you the bulls tried. They really tried to push the price up, but the bears swiped them back down with overwhelming force before the round ended. A long lower wick on a green candle shows the bears attempted a takedown, but the bulls found their footing and charged back, closing strong. This constant battle, this tug-of-war, is what creates the patterns you see on a chart. It's the raw, unfiltered psychology of the market made visible. And when one side starts winning consistently over time, that's when we get a trend. The most basic and most important skill in reading a chart is identifying the prevailing trend. This is like knowing which way the river is flowing. There are only three possibilities. First, the uptrend. This is the bull's triumphant march. An uptrend isn't just a straight line up. Remember, the bears are always fighting back. So an uptrend is defined as a series of higher highs and higher lows. Imagine a staircase going up. The price surges to a new high, then pulls back a little as bears take some profits or try to reverse the momentum. But the bulls hold the line at a level that's still higher than the previous low point. Then they gather strength and push to an even higher high. This pattern, higher high, higher low, higher high, higher low, is the classic signature of a bullish market. It's a visual representation of sustained optimism. Second, the downtrend. This is the bear's relentless assault. It's the exact opposite. A series of lower lows and lower highs. Think of a staircase going down. The price falls to a new low. Then buyers try to stage a rally, a small bounce. But the rally is weak. The bears re-engage and stop the price from reaching the previous high point, creating a lower high. Then they push the price down to an even lower low. This pattern, lower low, lower high, lower low, lower high, is the textbook definition of a bearish market. It's the picture of sustained pessimism. And finally, we have the third direction. The sideways market, also called a range or consolidation. This is a stalemate in the war. Neither the bulls nor the bears can gain a decisive advantage. The price bounces back and forth between two distinct levels, a ceiling and a floor. Imagine a tennis match. The price gets hit up to the ceiling, what we call resistance, and the bears smack it back down. It falls to the floor, what we call support, and the bulls hit it back up. This period of indecision can mean a lot of things. It could be the market catching its breath after a big move. Or it could be a period of uncertainty where traders are waiting for major economic news before picking a side. Learning to identify these three market conditions, uptrend, downtrend, and range, is like learning to read the market's body language. Is it confident and striding forward? Is it fearful and retreating? Or is it nervous and pacing back and forth, unsure of what to do next? You've now moved beyond the alphabet of individual candles. You understand the context of timeframes, the different zoom levels on our map. You understand the fundamental conflict between buyers and sellers, the bulls and the bears. And you can now identify the result of that conflict over time, the trend. You can look at any chart and within seconds answer the most important first question. Who is in control right now? By simply drawing lines connecting the highs and the lows, you can make the invisible structure of the market visible. You can see the staircases up or down, and you can see the horizontal channels of the tennis match. This simple skill alone separates you from the vast majority of people who look at a financial chart and see nothing but a chaotic, random scribble. You now see the story. But what about the most dramatic parts of that story? The turning points. The places where a triumphant bullish march suddenly grinds to a halt and collapses, or where a bearish descent miraculously finds its footing and begins a new charge. These critical locations on the chart have a name. and learning to identify them is the next piece of the puzzle. They are the battlegrounds where the war for the trend is won or lost. These battlegrounds are known as support and resistance. And understanding them is like learning to read the topography of the market's battlefield. It's the single most fundamental skill in chart analysis because it reveals the hidden psychological barriers that govern the flow of money. Let's start with a simple analogy. Imagine you're in a room with a floor and a ceiling, and you're bouncing a rubber ball. The floor stops the ball from falling further and sends it back up. That floor is support. The ceiling stops the ball from rising higher and sends it back down. That ceiling is resistance. In the financial markets, price acts just like that bouncing ball, moving between these invisible floors and ceilings created by the collective actions of millions of traders. Let's break down the floor first. Support is a price level or zone where buying pressure is strong enough to overcome selling pressure. It's a point where a downtrend is likely to pause or reverse. Think of it as a line in the sand where buyers say, "No further. This price is a bargain and we're stepping in." When the price falls to a support level, it's like a major retailer putting a popular item on a huge sale. Suddenly demand surges, buyers rush in, and the price is driven back up. So, how do these bargain basements get established? They form for a few key reasons. The most common is a previous swing low. The market has memory. If the price of the euro versus the US dollar fell to 1.0800, found a flood of buyers, and rallied strongly, traders remember that. The next time the price approaches 1.0800, two groups of people are watching intently. First, the buyers who got in at 1.0800 last time and made a profit are thinking, "This was a great spot to buy before, maybe it will be again." Second, the traders who watched that rally happen and kicked themselves for missing it are thinking, "I'm not making that mistake twice. If it gets back to 1.0800, I'm buying." This combined interest creates a pool of potential demand, a defensive line of buyers ready to act, forming a support zone. The more times a price level holds as support, the more times the ball bounces off that floor, the more significant that level becomes in the minds of market participants. When you're looking at a chart, you can spot these areas by finding at least two distinct lows that occur at roughly the same price. Imagine drawing a horizontal line connecting those low points. That line represents your potential support zone. It's not always a precise single price down to the penny. It's more like a thick crayon line, a zone where the psychology of the market shifts from fear to opportunity. Now let's look at the other side of the coin, the ceiling or resistance. Resistance is the mirror image of support. It's a price level or zone where selling pressure overwhelms buying pressure, causing an uptrend to pause or reverse. It's the point where sellers say, "This is too expensive. It's time to take profits or bet on a decline." When price rallies up to a resistance level, it's like trying to sell that same popular item for double its retail price. Buyers become hesitant, supply floods the market from those looking to sell, and the price is pushed back down. Resistance forms in the same way support does, just in reverse. A previous swing high is a classic source of resistance. If a currency pair rallied to 1.2500 and then sold off sharply, that level is now etched into the market's memory. Traders who sold at that peak and made a profit might look to sell there again. Buyers who bought at the very top, right before the price fell, are now holding a losing position. They might be desperately hoping for the price to get back to their entry point so they can sell and get out at break-even. Their desire to sell to avoid a loss adds to the selling pressure at that previous high, creating a formidable ceiling of supply. Just like with support, you can identify resistance by looking for at least two distinct peaks at a similar price level. Draw a horizontal line connecting them, and you have your battle line drawn. The more times the price hits this ceiling and gets rejected, the stronger that resistance is considered to be. It signifies a clear area where the sellers have consistently won the battle against the buyers. Now, here is where it gets really interesting, a concept that elevates your understanding from basic to intermediate almost instantly. Support and resistance levels are not permanent. The floor can break, and the ceiling can crumble. And when they do, something fascinating happens. Their roles often reverse. This is the principle of role reversal. When a support level is decisively broken, it can become the new resistance. Think about our room analogy again. If you stomp hard enough on the floor and break through to the level below, what was once the floor you stood on is now the ceiling above your head. The same psychology is at play in the markets. Let's say our support at 1.0800 finally breaks, and the price plummets to 1.0750. All those traders who bought at 1.0800, expecting a bounce, are now in a losing position. They are feeling regret and hoping for a small rally to get out without a major loss. If the price does manage to climb back up to 1.0800, what do you think they're going to do? They're going to sell. Their selling, combined with new sellers who see the broken support as a sign of weakness, creates a wall of supply right at the old support level. The old floor has become the new ceiling. The same is true for resistance. When a resistance level is broken, it can become the new support. If you burst through the ceiling, you're now standing on it, and it has become your new floor. Let's say the price smashes through that resistance at 1.2500 and rallies to 1.2550. This is a sign of significant strength from the buyers. Often, the price will then pull back to test the old resistance level of 1.2500. Traders who were hesitant to buy before might now see this pullback as a second chance to get in on the new trend. Their buying interest at that 1.2500 level can create a new floor of support where the old ceiling used to be. This breakout and retest is a classic pattern observed in many markets. Understanding this dynamic is like being given a partial map of the future. It allows you to anticipate where the next skirmish between buyers and sellers might occur. It's not about predicting the future with certainty. That's impossible. It's about identifying high probability zones where the market is likely to have a reaction. These are the points of decision. Will the old floor hold as a new ceiling? Will the old ceiling provide a foundation for the next move higher? The key is to remember that these are not magic lines. They are zones of human emotion, of fear and greed, of regret and opportunity. A price breaking through resistance isn't just a number changing on a screen. It's the story of sellers being overwhelmed, of hope turning into buying power. A price falling through support is the story of buyers giving up, of confidence turning into panic. By drawing these simple horizontal lines, you are not just marking up a chart. You are mapping the collective psychology of the market, identifying the key battlegrounds where the war for the trend will be decided. But the battlefield isn't always flat. Sometimes the battle is fought on a slope, in a steady march up or a grinding retreat down. The lines of engagement in these scenarios aren't horizontal. They are angled, dynamic, and they trace the very path of the trend itself. These are the hidden highways of the market, and learning to draw them is our next mission. These highways aren't paved with asphalt. They're drawn with a simple line tool, but they represent the collective will of millions of traders. Think of them as the desire paths of the market. In a park, you see those dirt trails cutting across the grass where people have found a more efficient route? That's what a trend line is. It's the path of least resistance that price has discovered, and our job is to trace it. Let's start with the most optimistic scenario: an uptrend. The market is making higher highs and, crucially, higher lows. It's like it's climbing a set of stairs. An uptrend line acts as the rising floor beneath those stairs. To draw it, you need to identify at least two significant low points, or swing lows, where the price dipped, found support, and turned back up. You click on the first major low, drag your mouse up, and connect it to the next major low. And that's it. You've drawn a line. It might seem almost too simple, but the power isn't in the drawing. It's in the interpretation. This line you've just created is now a dynamic, angled level of potential support. While horizontal support is a fixed price, this line is rising over time, providing a potential bouncing point for the price as it continues its journey upward. The real magic, the moment that makes traders lean into their screens, is the third touch. The first 2 points create the line. The third point validates it. When the price climbs, pulls back, and touches that line for a third time and bounces off. That's the market acknowledging your line. It's a moment of confluence, where your analysis aligns with the live, breathing action of the market. It's a powerful signal that the bulls are still in control, defending this upward trajectory. They are buying the dips along this specific angled path. Now let's flip the chart in our perspective. A downtrend. Here the market is making lower lows and lower highs. It's a controlled slide downwards. A downtrend line acts as the descending ceiling, capping any attempt by the price to rally. To draw this, you do the opposite. You find at least two significant high points or swing highs, where the price rallied, hit resistance, and was pushed back down. You connect the first peak to the second peak, extending the line out into the future. This line now represents a dynamic area of potential resistance. It's the visual representation of selling pressure. As the price falls and attempts to recover, it may run straight into this ceiling you've drawn. And just like with the uptrend, that third touch is key. If the price rallies up to the line a third time and is rejected, falling back down, it's a strong indication that the bears are firmly in command. They are selling the rallies at progressively lower prices, and your line has just pinpointed their defensive wall. So why does this even work? Is it some mystical geometry of the markets? Not at all. It's much more human than that. It works because of mass psychology. It's a self-fulfilling prophecy. When thousands, even millions, of traders around the world, from a hedge fund manager in New York to a retail trader in Chicago, all draw that same approximate line on their charts, it becomes a shared reality. They see the price approaching this line and they act. In an uptrend, as price nears the trend line, buyers see a potential bargain. They see a historically proven area of support, so they place buy orders. At the same time, sellers might close their positions, taking profits, which reduces selling pressure. This combination of increased buying and decreased selling is what can physically cause the price to bounce off that line. The line didn't have magical powers. The collective belief in the line created the outcome. It's the same story, just inverted for a downtrend. As price approaches the descending trend line, sellers see an opportunity to enter the market at a favorable price, and buyers who bought at the bottom get nervous and sell their positions. This wave of selling pressure is what can force the price back down. We're not just drawing lines. We're mapping out the psychological battlegrounds of the market. Now let's talk about the practical art of drawing them, because there are a few common pitfalls. First, don't force it. A valid trend line should be obvious. The swing points you connect should be significant peaks or valleys that stand out on the chart. If you have to squint and hunt for tiny little pivots to connect, the line probably isn't meaningful. The best trend lines jump out at you. Second, there's a classic debate. Should you connect the candle wicks or the candle bodies? The wicks, or shadows, represent the absolute highest and lowest prices reached in a period. The bodies represent the opening and closing prices. There isn't one single right answer, but here's a practical way to think about it. Drawing a line connecting the wicks captures the absolute extremes of market sentiment. Drawing a line connecting the bodies focuses on where the bulk of the trading and the real conviction lies. Many experienced traders will actually draw two lines, one for the wicks and one for the bodies, creating a small zone, or channel. This is a more advanced way of looking at it. Instead of a razor-thin line, you have a small buffer, a zone of support or resistance. For a beginner, the most important thing is to be consistent. Pick a method, wicks or bodies, and stick with it so you can interpret the results consistently. Another crucial detail is the angle of the trend line. The slope tells a story. A trend line that is incredibly steep, say 60 or 70 degrees, looks exciting, but it's often unsustainable. Think of it like a sprinter. They can't maintain that pace forever. These hyper-aggressive trends are prone to breaking dramatically. On the other hand, a trend line that is very flat, maybe less than 20 degrees, shows a lazy, weak trend with very little momentum. The sweet spot is often somewhere in the middle, like a healthy 30 to 45 degree angle, suggesting a steady, sustainable trend. It's the pace of a marathon runner, not a sprinter. Once you've mastered drawing a single trend line, you can take it a step further by creating a channel. A channel is simply two parallel trend lines that contain the price action. In an uptrend, you draw your main trend line connecting the lows. Then you draw a parallel line that connects the highs. This creates an ascending corridor. The bottom line is the buy zone. The top line is the potential take profit or sell zone. Price is effectively bouncing between these two parallel highways. In a downtrend, you draw your main trend line connecting the highs, and then you draw a parallel line connecting the lows. Now you have a descending channel, a corridor guiding the price lower. This is incredibly useful because it doesn't just define the trend. It helps define the potential range of the trend's movement. It frames the entire picture. But what happens when the rules are broken? What happens when price no longer respects these lines? This is, without a doubt, one of the most important signals a trend line can give you. When the price of a currency pair in an uptrend slices right through that rising floor, that trend line of support, it's called a break. It doesn't just mean the price went down. It means the entire structure of the trend is now in question. The staircase has collapsed. The bulls have lost control of their defensive line. Conversely, in a downtrend, when the price smashes up through that descending ceiling, it's a signal that the bears are losing their grip. The downward pressure is fading, and a change might be coming. A break of a trend line is a crack in the foundation of the current market sentiment. It's the market screaming that the game may be changing, that the balance of power between buyers and sellers is shifting right before your eyes. And understanding what that break truly means, and how to tell a real break from a fake one, is what separates basic chart readers from those who can truly interpret the market's language. So, how do we spot the difference between a genuine prison break and a head fake at the wall? It starts by understanding what a breakout actually is. Imagine a price chart for the euro versus the US dollar. For days, maybe even weeks, the price is just bouncing around between two invisible walls. It hits a ceiling, a point it just can't seem to push through, and falls back down. Then it hits a floor, a level where buyers always seem to step in, and it bounces back up. This box, this trading range, is our prison. The ceiling is called resistance and the floor is called support. A breakout is the moment the price finally smashes through one of those walls. It's a declaration. It's the market saying, the old rules don't apply anymore. The balance of power has shifted. If it breaks through the ceiling, the buyers have overwhelmed the sellers. If it crashes through the floor, the sellers have taken control. This moment is critical because it often signals the beginning of a new, powerful move in that direction. It's like a dam breaking. All that pressure that was building up inside the range is suddenly released, and the price can surge. For a chart reader, this is a flashing neon sign. It's a potential opportunity to catch the very beginning of a new trend. But here's the trap. And it's a trap that has cost countless aspiring traders their entire accounts. It's called the fakeout, or a false breakout. Picture this. The price has been pushing against that resistance ceiling all morning. You're watching it, your heart is pounding. It inches higher. And then bim, punches through. This is it. You think. The buyers are in control. You jump in, placing a trade, expecting the price to soar to the moon. But then something terrible happens. Just as quickly as it broke out, the price slams back down, crashing back inside the box. The breakout was a lie. It was a mirage. The market faked you out, and now you're trapped in a losing position. Why does this happen? Is the market just cruel? In a way, yes. You have to understand that the Forex market isn't just you and me. It's driven by massive institutions, banks, and hedge funds, what we call smart money. They need to buy and sell enormous amounts of currency, far more than you or I. To do that, they need someone on the other side of the trade. They need liquidity. So what do? They know that tons of retail traders, just like us, have placed their stop-loss orders just above that resistance level or just below that support level. A stop-loss is an automatic order to sell if the price drops to a certain point, to limit your losses. The smart money knows this. So, they can intentionally push the price just far enough to trigger all those stop-loss orders. When all those sell orders get triggered, it creates a huge pool of liquidity that allows the big players to fill their own massive buy orders at a better price. Then once they've gotten what they want, they let the price fall back into the range, leaving everyone who bought the breakout holding the bag. It's a brutal but fundamental aspect of market dynamics. Your job as a chart reader isn't to get angry about it. It's to learn how to spot it and avoid it. So, how do we build our fakeout detection kit? How do we increase the chances that the breakout we're seeing is the real deal? We need to look for confirmation. We need evidence. Never ever trust a breakout on its own. You need supporting actors to confirm the story the price is telling you. The first and most fundamental piece of evidence is the candle close. This is non-negotiable. A common beginner mistake is to see the price pierce a resistance level during a candle's formation and immediately assume it's a breakout. But that candle might have another 30 minutes before it closes. In that time, it could easily get pushed all the way back down. You must wait for the candle to officially close. If you're on a 1-hour chart, wait for that full hour to pass and see where that candle finishes. A true breakout is confirmed when the body of the candle, not just its wick, closes decisively outside of the support or resistance level. A long wick sticking out of the box with the body back inside is often a massive warning sign of a fakeout. It's the market testing the waters and being rejected. A strong full-bodied candle closing outside the box is your first piece of solid evidence. The second and arguably most powerful confirmation tool is volume. Volume tells you how many people are participating in a move. It's the roar of the crowd. Think about it. If a football team scores a game-winning touchdown, is the stadium quiet? No, it erupts. A real breakout is the same. It should be accompanied by a significant spike in trading volume. When you see the price break through a key level, you should immediately glance at the volume indicator at the bottom of your chart. Do you see a huge volume bar, one that's much larger than the preceding bars? That's the crowd erupting. That's conviction. It shows that a large number of market participants are backing this move with real money. Conversely, if the price trickles over a resistance level on very low, anemic volume, be extremely suspicious. It's like one person sneaking over the prison wall. They might not have the momentum or the backup to get very far. High volume is the fuel for a sustainable trend. A breakout without volume is a car trying to start a cross-country trip with an empty tank of gas. The third piece of our confirmation kit is a bit more advanced, but it's what can really separate the pros from the amateurs. It's called the retest. Markets have memory. Levels that were once important tend to remain important. When a resistance level, that old ceiling, is decisively broken, it often flips its role and becomes the new support level, the new floor. A classic sign of a strong, legitimate breakout is when the price breaks out, moves a little bit, and then pulls back to retest the very level it just broke. It's like a mountain climber reaching a new ledge, and then turning back to make sure it's solid before continuing the climb. What you want to see is the price come back down, touch that old resistance line, and then bounce off it, using it as a springboard to continue higher. This break and retest pattern is one of the most reliable formations in technical analysis. It shows that the market psychology has truly shifted. What was once a barrier is now a foundation. It gives you a second chance to enter the trade, not at the frantic moment of the break, but at a more logical, confirmed point. Let's walk through a quick story. Imagine the US dollar is strengthening against the Japanese yen, but it hits a wall at 150. For 3 days, it taps 150 and falls back. That 150 level is major resistance. On the fourth day, the 4-hour candle pushes up and pierces 150.05. Amateurs jump in, but you wait. The candle closes, and its body is almost entirely back below 150. It's a fake out. An hour later, a new candle forms. This one surges upwards with force. It closes at 150.40, a strong, solid candle completely clear of the resistance. You look down at your volume indicator. Boom! The volume bar is twice the size of the last 10 bars. This is confirmation number 2. You're interested, but you're patient. Over the next 8 hours, the price drifts back down. Comes all the way back to touch 150.01. For a moment, it looks like it might fail. But then buyers step in right at that old ceiling. The price bounces hard off the 150 level and starts climbing again. That was the retest. The old ceiling has now become the new floor. You now have 3 pieces of strong evidence suggesting this is a genuine shift in the market. The story the chart is telling is now much clearer, much more reliable than that first impulsive spike. This is how you read between the lines. This is how you move from just seeing prices on a screen to understanding the narrative of the market. Now you're not just guessing. You're building a case like a detective, looking for clues that all point to the same conclusion. And once you've confirmed that a real breakout has occurred, a whole new world opens up. Because a breakout isn't the end of the story. It's the beginning of the next chapter. It's the birth of a trend. And identifying, understanding, and navigating these trends is the absolute core of reading a Forex chart. That's where the real journey begins. So if a breakout is the birth of a trend, what does that trend actually look like? How does it behave? Think of it this way. A chart is telling a story and a trend is the main plot. It's the market's body language. Is it feeling optimistic and climbing higher? Is it pessimistic and sliding lower? Or is it indecisive, just pacing back and forth? These are the 3 fundamental states of any market, and they are called an uptrend, a downtrend, and a sideways market. Let's start with the optimist. The uptrend. An uptrend is a beautiful stair-stepping pattern, moving from the bottom left of your chart to the top right. But it's not a straight line. The market breathes. It pushes up, then pulls back to catch its breath, then pushes to a new higher point. This rhythm creates a very specific pattern, a series of higher highs and higher lows. Imagine a mountain climber. They climb for a while, reaching a new peak that's a high. Then they descend a little to find a secure spot to rest. That resting spot is a low. But because they're making progress, their next push takes them to a peak that is higher than their previous one. That's a higher high. And their next resting spot, though a dip, is still at a higher altitude than their last one. That's a higher low. As long as the market is making higher highs and higher lows, it's in a confirmed uptrend. It's a picture of strength and forward momentum. Now let's flip the coin and look at the pessimist, the downtrend. This is the exact opposite. It's a cascade of prices moving from the top left of your chart to the bottom right. Our mountain climber is now heading back down to base camp. They descend to a new valley, a low. Then, they might climb up a little bit to navigate around an obstacle, creating a temporary high. But their next descent takes them to a valley that is lower than the previous one. a lower low. And their next small climb up only reaches a point that is lower than their previous high, a lower high. This pattern of lower lows and lower highs signals a downtrend. It's a picture of weakness where sellers are in control, pushing the price down with each new wave. Finally, we have the indecisive market, the sideways or ranging market. This is our mountain climber pacing back and forth at a base camp, deciding which route to take next. The price isn't making significant new highs or new lows. Instead, it's bouncing between two relatively horizontal levels, a level of support on the bottom and a level of resistance on the top, just like we discussed before. The market is in a state of equilibrium. Buyers and sellers are evenly matched, and neither side can gain control to push the price into a new trend. This period of consolidation is the market taking a deep breath, often coiling up with energy before its next big move. A breakout that will start a new uptrend or downtrend. Okay, so we can conceptually understand these three states. But how do we physically see them and track them on a chart? The single most fundamental tool for this is the trend line. A trend line is exactly what it sounds like, a line you draw on your chart to make the trend obvious. It clarifies the noise and gives you a visual boundary for the market's movement. Let's go back to the uptrend with its pattern of higher lows. To draw an uptrend line, you simply connect the lows. You find at least two of those resting spots or dips, and draw a straight diagonal line that runs underneath them. This line acts as a sort of dynamic support. As long as the price stays above this rising line, the uptrend is considered intact. Every time the price comes down and touches this line, it has historically been a point where buyers step back in and say, "Nope, the price is not going lower," and they push it back up, continuing the trend. For a downtrend, you do the opposite. You look at the pattern of lower highs, those temporary peaks in the downward slide. You connect at least two of those highs with a straight diagonal line that runs above the price action. This line acts as a dynamic resistance. As long as the price stays below this falling line, the downtrend is considered active. Each time the price rallies up to touch this line, it has historically been a point where sellers re-emerge and push the price back down. Sounds simple, and it is. But here is the single biggest trap that almost every new trader falls into. They learn about trend lines, open up a chart, and suddenly see them everywhere. They start connecting any 2 points and treating it as a gospel truth. This is a critical mistake. A line that connects only 2 points, 2 lows in an uptrend or 2 highs in a downtrend, is not a confirmed trend line. It is a potential trend line. It's a hypothesis. It's you saying, okay, I see a potential pattern forming here. The magic, the confirmation, the moment that line goes from a pencil sketch to a blueprint, is the third touch. When the price moves along and comes back to touch your potential trend line for a third time and then bounces off it, that is the market validating your observation. It's a powerful signal. Why? Because it means other traders around the world, looking at the same chart, are seeing the exact same line. They are placing their orders based on it. That third touch is a moment of collective agreement. It transforms your private analysis into a publicly acknowledged battlefield. In an uptrend, that third touch on the line is where a wave of buyers confirms that this level of dynamic support is real. In a downtrend, that third touch is where sellers confirm that the dynamic resistance is holding strong. So the rule is simple but profound. 2 points to draw the line, a third point to confirm it. Anything less is just speculation. Waiting for that third touch requires patience, a virtue that the market rewards handsomely. It keeps you from jumping into weak, unconfirmed moves and helps you focus on trends that have demonstrated their strength and resilience. And these trends aren't just random squiggles on a screen. They are often driven by powerful real-world forces, especially here in the US. Think about a major announcement from the Federal Reserve about interest rates. If the Fed signals it's going to raise rates, that can strengthen the US dollar, potentially kicking off a powerful downtrend in a pair like the euro to US dollar. Conversely, a surprisingly strong US jobs report might boost investor confidence, starting a new uptrend. These fundamental events are often the engines that create the powerful, long-lasting trends that can be visualized with simple trend lines. The lines on the chart are just the footprint of these giant economic forces at play. So now you know the 3 states of the market. You know the anatomy of an uptrend and a downtrend. And you have the most basic yet powerful tool for identifying them: the trend line, along with the crucial 3-touch rule for confirmation. You can now look at a chart and begin to decipher the main plot of its story. But here's the next critical question. You've identified a trend. You've drawn the line. It's been confirmed with a third touch. But how do you know if this trend is a powerful freight train, just getting started on a long journey? or if it's a temporary gust of wind that's about to die out. How do you measure its health, its momentum? Because not all trends are created equal, and telling the difference between a trend that has legs and one that's on its last breath is what separates consistent analysis from hopeful guessing. That's the million-dollar question, isn't it? Imagine a marathon runner. From a distance, you see them moving forward, making progress. That's the trend. But as you get closer, you start to notice other things. Are their shoulders slumped? Is their breathing ragged? Is their pace starting to falter, even if they're still technically moving forward? That's momentum. It's the underlying strength, the engine driving the price. And just like with a runner, there are tools we can use to look under the hood of a price trend and measure its true health. These tools are a family of indicators known as oscillators. Don't let the fancy name scare you. An oscillator simply moves or oscillates back and forth between two extremes like a needle on a gauge. They don't measure the absolute price level. They measure the speed and change of price movements. They are our momentum detectors, our trend health monitors. And today we're going to break down two of the most popular and widely used oscillators in the entire world of trading: the RSI and the MACD. Let's start with the RSI, which stands for the Relative Strength Index. Think of the RSI as the heart rate monitor for the market. It measures the speed and magnitude of recent price changes on a scale of 0 to 100. Its primary job is to help us identify potential overbought and oversold conditions. Now, traditionally, a reading above 70 is considered overbought, and a reading below 30 is considered oversold. But here's the critical distinction that trips up so many beginners. Overbought does not automatically mean sell, and oversold does not automatically mean buy. Let's go back to our marathon runner. If their heart rate is really high, does that mean they're about to collapse? Not necessarily. It might just mean they're in an all-out sprint to the finish line. A strong, healthy trend can stay overbought for a very, very long time. In fact, in a powerful uptrend, the RSI might hover above 70 for days or even weeks. Trying to sell just because the RSI crossed 70 is like stepping in front of a freight train. So, if these levels aren't simple buy or sell signals, what are they good for? They are warning signs. They are context. An RSI above 70 tells us, hey, the price has moved up very quickly very recently. The buying has been aggressive. Pay attention. An RSI below 30 tells us, wow, the selling has been intense. The price has dropped fast. Take note. It's information. It's a piece of the puzzle. The real power of the RSI, the thing that makes analysts lean forward in their chairs, is a concept called divergence. This is where the story gets interesting. Divergence is when the price is telling you one story, but the momentum indicator is telling you a completely different one. Imagine the euro to US dollar is in a strong uptrend. The chart makes a new high. Then it pulls back a little, and then rallies to make an even higher high. The price is clearly going up. But when you look down at your RSI indicator, you see something strange. When the price made that first high, the RSI peaked at, say, 80. But when the price made its second higher high, the RSI only managed to peak at 72. The price made a higher high, but the momentum indicator made a lower high. This is classic bearish divergence. What is it telling us? It's our marathon runner, still moving forward, even setting a new personal best time for that lap. But their heart rate is actually lower than it was on the previous lap. The effort, the power, the momentum behind that new high is weaker than it was before. It's a sign of exhaustion. It's a potential clue that the trend might be running out of steam and could be due for a reversal or a significant pullback. It's not a guarantee, nothing is, but it's a massive red flag that the strength of the buyers is waning. The same thing works in reverse, which we call bullish divergence. Let's say the price makes a low, bounces, and then falls to make a new lower low. A clear downtrend. But the RSI on that second lower low actually prints a higher low than it did on the first one. Price is going down, but the momentum of the selling is decreasing. The sellers are getting tired. This could suggest that the downtrend is losing its power, and the market might be getting ready to turn around. Divergence is one of the most powerful concepts you can learn, because it gives you a glimpse into the internal dynamics of the market that price alone doesn't show you. Now let's talk about the second tool, the MACD. It sounds complex. Moving Average Convergence Divergence. Let's just call it the MACD, pronounced MACD. While the RSI is like a heart rate monitor, the MACD is more like a GPS tracker that compares your current speed to your average speed. It's designed to reveal changes in the strength, direction, momentum, and duration of a trend. The MACD has three main components you'll see on your chart. First, there's the MACD line itself. Second, there's the signal line, which is essentially a smoothed out version of the MACD line. And third, there's the histogram, which looks like a little bar chart. The histogram is the secret sauce for many analysts. It visually represents the distance between the MACD line and the signal line. Here's how it works in practice. When the MACD line crosses above the signal line, it's often interpreted as a potential signal that momentum is shifting to the upside. Our runner is starting to accelerate past their recent average speed. When the histogram, which was below the zero line, flips and starts printing bars above the zero line, this confirms the crossover. As those bars get taller, it indicates that the upward momentum is getting stronger and stronger. Conversely, when the MACD line crosses below the signal line, it suggests momentum is shifting to the downside. The runner is slowing down, falling behind their average pace. The histogram will flip to be below the zero line, and as its bars get longer and longer downwards, it shows that downside momentum is accelerating. But just like the RSI, the real magic isn't just in the crossovers. It's in reading the story the indicator is telling. Look at the histogram. Imagine the market is in a strong uptrend. The MACD line is above the signal line, and the histogram is showing tall green bars. Everything looks great, but then you notice the next few bars on the histogram are a little shorter, and the next are shorter still, even while the price might still be inching higher. What is this telling you? It's showing that the rate of acceleration is slowing down. The gap between the MACD line and the signal line is shrinking. Momentum is fading. Our runner is still in the lead, but their lead is shrinking. They're not pulling away anymore. This fading momentum, visible on the MACD histogram, can be an early warning sign that a trend is getting tired, often appearing even before an RSI divergence or a clear price pattern breakdown. It's another clue that the character of the market is changing. So, how do we put this all together? You don't use these tools in a vacuum. They are part of a dashboard. You've already learned how to identify the trend and draw support and resistance levels. Now you have tools to measure the health of that trend. Let's build a hypothetical scenario. You see the US dollar to Japanese yen in a beautiful uptrend, making higher highs and higher lows. You've identified a key resistance level up ahead. As the price approaches that resistance level, you look at your momentum indicators. You notice bearish divergence on the RSI. The price is making a new high, but the RSI is making a lower high. At the same time, you look at your MACD histogram, and you see that the bars are getting shorter and shorter, showing that the upward momentum is fading fast. Now you have a much more complete picture. The trend is up, but it's approaching a known obstacle, resistance, and two different momentum indicators are screaming that the engine is sputtering. This doesn't guarantee a reversal, but it provides a strong case that the risk of continuing to buy at these levels has increased significantly, and the potential for a pullback or reversal is much higher. You're combining price action with momentum analysis to make a more informed assessment. You're not just looking at the runner, you're checking their vitals as they approach a steep hill. This is the essence of technical analysis. It's about building a case, gathering evidence from different, non-correlated sources to understand the market story. Price tells you what is happening. Oscillators like RSI and MACD help tell you how it's happening, and with how much conviction. They help you see beyond the surface, to differentiate between a trend that's just getting started and one that's on its last legs. But this brings up a crucial point. All of these tools, trends, support, resistance, RSI, MACD, they work best when the market is actually moving in a clear direction. But what happens when it's not? What about those times when the chart just looks like a chaotic sideways mess, bouncing around with no clear purpose? How do you analyze a market that has no trend? How do you even survive those choppy waters? That's a completely different environment, and it requires a completely different set of tools and a different mindset. This is the trader's purgatory. A market that isn't going up, isn't going down, it's just going sideways. We call this a ranging market, a consolidating market, or simply the chop. Think of a trending market as a car on an open highway, cruising in one direction. A ranging market is that same car stuck in downtown traffic during rush hour. It lurches forward a block, hits a red light, stops, waits, then lurches forward again, only to be stopped by the next light. It's frustrating, it's noisy, and if you're not careful, it's where accounts can get slowly bled dry. So how do we even begin to make sense of this? The first step is acceptance. You have to recognize the environment you're in. The tools that work beautifully on the open highway, like our trend-following moving averages, can give you whiplash in city traffic. In a ranging market, those moving averages will often be tangled together, crisscrossing back and forth, offering no clear direction at all. That mess of lines is your first clue. The trend is gone for now. Instead of looking for direction, we start looking for boundaries. A ranging market is defined by a clear ceiling and a clear floor. The ceiling is our old friend, resistance, and the floor is support. The price is effectively trapped inside a box, bouncing between these two levels. Your first job is to draw that box. Look at your chart. Can you identify at least two clear peaks at roughly the same price level? Draw a horizontal line connecting them. That's your resistance. Now, can you see at least two clear troughs at a similar price level below? Draw another horizontal line there. That's your support. If the price action is respecting these two lines, hitting the top and turning back down, hitting the bottom and turning back up, congratulations, you've identified a range. This box is now your entire world. The grand narrative of an uptrend or a downtrend has been paused. The story is now about the battle between buyers at the floor and sellers at the ceiling. Now, because trend-following indicators are less reliable here, we turn to a different class of tools: oscillators. The name sounds complex, but the concept is simple. Oscillators oscillate back and forth between two extremes, typically indicating overbought or oversold conditions. They are designed to measure the momentum of price moves within a defined boundary, which makes them uniquely suited for ranging markets. Let's talk about the king of oscillators, the Relative Strength Index, or RSI. The RSI is a single line on your indicator panel that moves between 0 and 100. It measures the speed and magnitude of recent price changes. The traditional interpretation is that a reading above 70 suggests the asset is becoming overbought, and a reading below 30 suggests it's becoming oversold. Now, this is critically important. In a ranging market, overbought doesn't mean sell immediately, and oversold doesn't mean buy immediately. Think of it as an early warning system. Imagine our currency pair is bouncing inside its box. As the price climbs and gets close to that resistance line you drew, you glance down at your RSI. If you see it creeping above 70, that's a piece of confirming evidence. It suggests that the buying momentum is getting exhausted. The buyers are running out of steam right as they hit the wall of sellers at resistance. This confluence, price at resistance plus an overbought RSI, is what many traders look for as a higher probability signal that the price might reverse and head back down toward support. The same logic applies at the bottom of the range. As the price falls toward your support line, you see the RSI dip below 30. This suggests selling momentum is drying up. The sellers are getting tired just as they run into the wall of buyers at support. It's a potential sign that the price could bounce back up. The RSI helps you gauge the internal strength of the moves between the floor and the ceiling. Another hugely popular oscillator is the stochastic oscillator. It looks a little more complex with two lines, but it operates on a similar principle. It compares where a currency's price closed relative to its price range over a period of time. Like the RSI, it has overbought, typically above 80, and oversold, typically below 20 zones. Many traders watch for the two lines of the stochastic to cross over while in one of these zones. For instance, if the price is near resistance and the stochastic is overbought above 80, a downward cross of its lines could be seen as another signal that momentum is shifting and the price may be ready to turn lower. Using these oscillators, traders generally approach ranging markets in one of two ways. The first is to trade the range. This strategy involves looking for opportunities to enter trades near the boundaries. A trader might look for a potential sell entry near resistance, especially if an oscillator signals an overbought condition. Conversely, they might look for a potential buy entry near support, especially if an oscillator signals an oversold condition. The key here is patience and confirmation. You don't just place an order the second the price touches the line. You wait. You watch for the price to show you it's actually rejecting that level, maybe through a specific candlestick pattern that we'll discuss later, and you look for that confirming signal from your oscillator. The second approach is to do nothing at all inside the range and simply wait for the breakout. This is for traders who prefer trends and find the choppy back and forth action too unpredictable or stressful. They draw their box, set an alert, and walk away. Their entire strategy is based on waiting for the consolidation to end, because every range eventually breaks. The price will either smash up through resistance or crash down through support, and when it does, it often signals the beginning of a new, powerful trend. A breakout trader is like a coiled spring. The ranging market is the compression phase, building up energy and pressure. The breakout is the release of that energy. A valid breakout is typically seen as a strong, decisive candle that closes well outside of the established range. A common tactic is to then wait for a retest. This is where the price, after breaking out, pulls back to touch the old boundary line one more time before continuing in its new direction. For example, if the price breaks above resistance, that old ceiling now often becomes a new floor of support. A retest is when the price comes back down to test this new support. If it holds, it's a powerful confirmation for many that the breakout is real, and the new uptrend has legs. Whichever approach one might consider, the psychology of a ranging market is its own beast. It's the ultimate test of discipline. The moves are smaller, the targets are closer, and the temptation to overtrade is immense. When the price is just chopping around, it can feel like you should be doing something. This leads to taking low-quality trades in the middle of the range, the no man's land, where the odds are not in your favor. Surviving a ranging market is less about brilliant entries and more about iron-willed patience. It's about having the discipline to wait for the price to come to your predefined levels of interest, the edges of the box, and having the fortitude to sit on your hands and do nothing when it's meandering in the middle. This distinction is what separates amateurs from seasoned traders. Amateurs hunt for action. Professionals wait for opportunity. They understand that capital preservation during the chop is just as important as profit generation during a trend. They know that these periods of consolidation are a normal, healthy part of any market cycle. They are the market taking a breath before its next big move. So we've now explored the two primary states of the market, the directional flowing trend and the sideways contained range. We have different tools and different mindsets for each, but the market is a dynamic living thing. It transitions between these states. A powerful trend will eventually get tired and enter a range, and a quiet range will eventually break out into a powerful trend. How do we spot those transitions? Are there specific formations on the chart that act as warning signs, telling us that the character of the market is about to change? These formations, known as chart patterns, are like the market's body language, and learning to read them is the next critical layer in our journey. These formations are the market showing its hand, revealing the collective psychology of millions of traders in a single recognizable shape. Think of it like this. If price action is the individual words and sentences, chart patterns are the complete paragraphs, telling a story of struggle, exhaustion, or consolidation. Let's start with the most dramatic stories the market tells, the plot twists. These are called reversal patterns, and they signal that the prevailing trend might be running out of steam and is about to change direction. The undisputed king of all reversal patterns is the head and shoulders. Imagine a strong uptrend, a story of buyers, the bulls, being in complete control. They push the price up to a new peak, let's call that the left shoulder. They're feeling confident. After a small dip, they gather all their strength for one final massive push, driving the price even higher to an ultimate peak. This is the head. But at this new height, the air is thin. The buying pressure is exhausted. Sellers, the bears, see this exhaustion and start to step in, pushing the price back down, usually to the same level as the previous dip. Now the bulls try one more time to rally, but their hearts aren't in it. They can only manage a weak push upwards, forming a lower peak, the right shoulder, before the sellers take over completely. The line connecting the two lows, the one between the shoulders, is called the neckline. And when the price breaks below that neckline, it's like the final act of the tragedy. The bulls have lost the battle. Their final rally has failed, and a new downtrend is often the result. This pattern tells a powerful story of a trend's climax and subsequent collapse. The inverse head and shoulders is the exact same story, just flipped upside down, signaling a potential end to a downtrend and the beginning of a new rise. It's a story of hope after despair. A simpler but equally powerful plot twist is the double top or double bottom. Imagine the price is in a strong uptrend and hits a ceiling, a strong resistance level. It gets rejected and pulls back. The buyers, still optimistic, regroup and charge that same ceiling again. But they fail a second time. Hitting that same wall twice is a huge psychological blow. It tells the market that the buyers just don't have the strength to break through. This M shape is a double top, and it often precedes a significant move down. Conversely, a double bottom, which looks like a W, tells the opposite story. A market in a downtrend hits a floor, a support level, and bounces. The sellers push it back down to test that floor one more time, but it holds again. That second successful defense shows that buyers are stepping in and defending that price. The selling pressure is drying up, and the trend could be about to reverse to the upside. The story here isn't one of a dramatic climax like the head and shoulders, but one of pure exhaustion. The trend simply ran out of gas trying to break through a key level. But not every pause in the action is a plot twist. Sometimes the market is just catching its breath. These are called continuation patterns, and they suggest that the original trend is likely to resume after a brief break. Think of bull flags and bear flags. Picture a currency pair like the euro/US dollar in a very strong, sharp uptrend. The price shoots up almost vertically. That's the flagpole. Then, instead of reversing, the price just drifts sideways or slightly down in a tight, orderly channel. It's like an army that just won a major advance, and now they're stopping to consolidate their position, regroup, and resupply before the next push. This little channel is the flag. When the price breaks out of the top of that flag, it often signals the continuation of that initial powerful move upwards. A bear flag is the mirror image, a sharp drop, followed by a weak upward drifting consolidation before the next leg down. These patterns are valuable because they help distinguish a temporary pause from a full-blown reversal. Then we have the triangles. Triangles are all about coiling energy. They represent a period of indecision where the range between the highs and the lows gets tighter and tighter, squeezing the price like a spring. First, there's the symmetrical triangle. This is when you can draw a descending trend line connecting the lower highs and an ascending trend line connecting the higher lows. Both lines are converging towards each other. This pattern represents pure equilibrium and uncertainty. The bulls and bears are evenly matched, but neither is giving up. The price is getting squeezed into a tighter and tighter corner. Eventually, the spring has to uncoil. The price will break out of one of the trend lines, and this breakout often leads to a strong move in that direction. The triangle itself doesn't tell you which way it'll go. It just tells you that a significant move is becoming more and more likely. Next is the ascending triangle. This is a more bullish setup. You have a flat, horizontal resistance level at the top, a ceiling that the price keeps hitting, but on the bottom you have a rising trend line of higher lows. This tells a story of buyers becoming more and more aggressive. They are willing to buy at higher and higher prices, relentlessly pushing up against that flat ceiling. The sellers are holding the line at that resistance level, but the pressure is building from below. It's like water pressing against a dam. Eventually, if that dam breaks, the resulting move to the upside can be very powerful. The opposite is the descending triangle, a bearish setup. Here you have a flat support level, a floor, and a descending trend line of lower highs. This is the story of sellers getting more aggressive. They are willing to sell at lower and lower prices, putting constant pressure on that support floor. The buyers are holding the line, but the selling pressure is intensifying from above. If that floor gives way, a significant downward move can follow. Now, here is the most critical part of understanding patterns, and it's where many beginners get into trouble. Pattern is not a guarantee. It is a suggestion. It's a historical tendency, not a crystal ball. A head and shoulders pattern isn't complete until the neckline is broken. A triangle isn't confirmed until the price has decisively broken out of one of its sides. Acting before this confirmation is like trying to guess the end of the story before the final chapter is written. You might be right, but you're just guessing. Furthermore, patterns can and do fail. An ascending triangle can break to the downside. A bull flag can turn into a reversal. This is not a failure of the concept. It's a reflection of the market's complexity. That's why context is everything. A bull flag appearing in a clear, established uptrend, right after bouncing off a major support level we identified earlier, is a much more compelling story than one appearing randomly in choppy, sideways price action. Each pattern you spot has to be weighed against the broader market structure, the support and resistance levels, the overall trend, the story the candlesticks are telling you. These patterns are not magic formulas. They are tools for understanding market psychology. They help us frame the ongoing battle between buyers and sellers, giving us a narrative to follow. They show us where the market is coiled with energy, where it's exhausted, and where it might be about to make its next big move. Learning to spot these formations gives you a framework, a way to organize the chaos of the chart into recognizable stories. But spotting the story is one thing. Knowing how to act on it, how to manage your capital when you think you know how the story will end, and what to do when the plot takes an unexpected turn, that is an entirely different skill set. We've learned to read the map, we've identified the key levels, and now we can even see the battle plans taking shape. So how do we bring it all together into a coherent strategy? How do we use indicators to add another layer of confirmation? And most importantly, how do we protect ourselves when the market inevitably proves our analysis wrong? That is the final and perhaps most crucial piece of this entire puzzle. Let's assemble that puzzle piece by piece, starting with the framework of a trading strategy. A strategy isn't some secret formula you find on the internet. It's your personal rulebook. It is a predefined, objective set of conditions that must be met before you risk a single dollar in the market. It dictates your entry, your exit, and how you manage the trade in between. It is the single most important tool for removing emotion, fear, and greed from your decision-making process. So, what does a simple foundational strategy look like? Let's build one right now, using only the tools we've already discussed. Imagine we're looking at the euro to US dollar chart on the 4-hour time frame. First, our rulebook needs a market condition. Rule number 1 for our hypothetical strategy. We only look for buying opportunities when the price is in a clear, confirmed uptrend. That means we've drawn our trend line, and we're seeing a consistent pattern of higher highs and higher lows. If the market is choppy or in a downtrend, we sit on our hands. We do nothing. This first rule alone filters out a huge number of low probability setups. Second, our rulebook needs an entry signal. What specific event tells us now might be the time to enter? Let's combine two of our concepts. Rule number 2. We will only consider entering a long position when the price pulls back to and touches our established uptrend line, which also lines up with the key horizontal support level. At that point of confluence, we will look for a clear bullish candlestick pattern, like a bullish engulfing candle or a hammer. This isn't just a random entry. It's a specific, observable event at a location of historical significance on the chart. Now, we have a basic framework, but professional analysis often involves another layer: confirmation. This is where indicators come in. Indicators are mathematical calculations based on price or volume, displayed graphically on your chart. They are not magic crystal balls. They are tools to help confirm the price action you're already seeing. They should support your thesis, not create it. Let's add two of the most common indicators to our strategy. The first is the moving average, or MA. A moving average smooths out price data to create a single flowing line, giving you a clearer view of the overall trend direction. A very common approach is to use two moving averages, a short-term one like the 50-period MA, and a long-term one like the 200-period MA. When the 50 MA is above the 200 MA, it's often seen as confirmation of a bullish long-term trend. So let's add that to our rulebook. Rule number 3. The 50-period moving average must be above the 200-period moving average. Furthermore, the price action we identified in Rule 2, the pullback to support, should ideally find support near one of these moving averages, which often act as dynamic zones of support and resistance. The second indicator we'll consider is the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. It moves between 0 and 100. Traditionally, a reading above 70 is considered overbought, and a reading below 30 is considered oversold. For our strategy, we can use this to avoid buying at a potential peak. So rule number 4. When our bullish entry signal appears at support, the RSI should not be in the overbought territory, above 70. This suggests there may still be room for the price to move upwards. Look at what we've just done. We've created a 4-part checklist. To even consider a trade, the market must be in an uptrend, price must pull back to a confluence of support, a bullish candle must form, the moving averages must confirm the trend, and the RSI must not be overbought. This systematic approach is the core of a trading strategy. But even with the perfect set of entry rules, you can and you will be wrong. The market can and will do whatever it wants. This brings us to the most crucial piece of this entire series: risk management. This is what separates consistently profitable traders from the 90% who fail. First, the stop loss. A stop loss is a preset order you place with your broker to automatically close your trade at a specific price if the market moves against you. It is your non-negotiable safety net. It defines your maximum acceptable loss on any single trade. Before you ever click the buy button, you must know exactly where you will get out if you are wrong. In our strategy example, where would that be? A logical place would be just below the low of our bullish entry candle, or slightly below the support level itself. This gives the trade a little room to breathe, but clearly defines the point at which our analysis is proven incorrect. If the price hits that level, we accept the small, manageable loss and move on to the next opportunity, with our capital preserved. Second, the take profit. Just as you need a predefined exit for a losing trade, you need one for a winning trade. This is your target. Where do you plan to take your profits off the table? A logical place is the next significant resistance level above your entry. You identify this level before you enter the trade. This prevents greed from taking over and turning a winning trade into a losing one because you held on for too long. Now let's connect these two concepts with the idea of the risk-to-reward ratio. This is a simple comparison between the amount of money you're risking, the distance from your entry to your stop loss, and the amount you stand to potentially gain, the distance from your entry to your take profit. Let's say in our euro to US dollar example, our entry is at 1.0850. Our stop loss is placed at 1.0800, meaning we are risking 50 pips. Our take profit target is at the next resistance level, which is at 1.1000. This means our potential reward is 150 pips. Our risk is 50 pips, and our potential reward is 150 pips. This gives us a risk-to-reward ratio of 1 to 3. For every $1 we are risking, we are aiming to make 3. This is a powerful concept. Why? Because it means you don't have to be right all the time. Think about it. With a 1 to 3 risk-to-reward ratio, you could be wrong on 3 trades, losing 1 unit each time for a total loss of 3 units. But then, on your 4th trade, you are right and you make 3 units. You are now back to break-even, even though you only had a 25% win rate. If you win just 2 out of 5 trades with this ratio, you are profitable. This mathematical edge is the foundation upon which sustainable trading careers are built. A core rule for many traders is to never take a trade unless it offers a favorable risk-to-reward ratio, often at least 1 to 2 or better. So let's recap this entire journey. We started with the absolute basics of what a Forex chart is. We learned to read candlesticks, the language of price. We learned how to identify the market structure through support, resistance, and trend lines. We explored chart patterns that signal potential reversals or continuations. And now we've assembled it all into a coherent, rule-based strategy, complete with confirmation from indicators and, most importantly, a robust risk management plan. This knowledge is your foundation. But the journey of a trader is one of continuous learning, and more than anything, self-mastery. There is no magic indicator or secret strategy that works 100% of the time. The market is a dynamic, ever-evolving environment. Your job is to use these tools to put the probabilities in your favor, and then to manage your risk with unwavering discipline. The final step before you ever trade with real money is to practice. Open a demo account, a practice account with virtual money, and apply what you've learned. Test your strategy. See what works and what doesn't. Keep a trading journal. Write down every trade you take. Why did you enter? What was your risk management plan? What was the outcome? What did you learn? This journal will become your most valuable coach. Learning to read a chart is like learning a new language. At first, it's just noise and confusing symbols. But with practice, you start to see the grammar, the structure, the narrative. You begin to understand the story the market is telling you. This 10-part series was your introductory textbook. The real learning begins now with every chart you study and every trade you analyze. Approach it with discipline, respect for risk, and a commitment to lifelong learning. And you will have given yourself the best possible start on this challenging but fascinating journey.